All right, in this video, I'm going to talk a little bit about the difference between spot prices and futures prices. And so this kind of relates to how financial markets operate a bit. So a spot price is the price paid for the asset more or less today. So pretty much if I buy the asset, take possession today, that's the basic idea behind the spot price. Futures price is the price specified in a contract created today to buy the asset at a specified future time. So if I enter into a contract today, so I sign on the dotted line today, and I promise to buy the asset, say, in 6 months, then the price that's specified in that contract that I will pay in 6 months, that would be the futures price. Now, that basically means that there's sort of a difference in terms of how this is going to play out for people, right? So if I buy a share of stock today, then I have that, and then whatever happens to the price, basically over say the next 6 months is going to reflect kind of my gains, and whatever or losses, right? And so basically, if I buy a share of stock today, and the stock goes up by a certain percentage point or a certain percentage amount, then basically that's going to show essentially the gain is going to be related to what I paid for it versus what the increase in the price is. For the futures, if I enter into a contract to buy a share of stock, my gain is going to be linked to basically what did I agree in the contract to pay for that share of stock in 6 months, and what is the price of the share of stock relative to that at the end of the 6 months. So basically, it's all going to be coming down to what that price is in the contract relative to what the price is at the end of the 6 months, and that is going to dictate whether I have a gain or a loss, basically. And the same thing is true if I'm looking at an ounce of gold. If I buy an ounce of gold today, my gains over the next 6 months are going to be relative to I paid this amount today, and the price, here's what the price did over the next 6 months, and that's going to dictate my gain. If I enter into a contract to buy the ounce of gold, then what's going to happen is, in order to figure out what happens at the end of 6 months, I got to look at what was my agreed upon price in the contract, and then at the end of the 6 months, where's the price of gold relative to that, and then that will dictate what my gains or losses are. So my gains and losses for futures contracts are related to what that futures price is, and then what ultimately winds up being the spot price at the end of that contract. In other words, what happens to be the going price for the asset when the contract comes due. So it gets a little bit interesting there. Now, just as a note, as it pertains to terminology, often the term spot price or futures price will often be used with commodities. So you might see that with the futures price for oil, or a spot price of oil, or something like that. So they're often used with commodities, but those terms do apply more broadly as well, and they can apply for things like shares of stock, ounces of gold, treasury securities, and even currencies and things like that. So the terminology does apply more broadly as well. All right, hopefully this video has been helpful. Thank you so much for watching, and have a great day.